Alrighty, I think we're going live correctly. Bear with me two guys. Yep, no, all good. Just double check. Alrighty guys, thanks for tuning in. Give me 2 seconds, guys. I just want to make sure I'm live correctly. I haven't done it for a little bit, sorry guys. So see how we go. Sorry guys, 2 seconds. All righty, so I'm just going to wait for a couple of minutes for a few more people to join, guys, and then we'll get cracking. I won't keep you too long. Sometimes I talk too much, but today it's going to be quick, 20, 30 minutes max, just to break down a little bit. So the reason for me going live is I did a post of a property we bought for a client there. I think it may have been last week, and I've had several messages, lots of comments, and people just wanted to know, or probably a lot of people didn't realize they can actually buy property with their superannuation. So just as a disclaimer though, guys, I am not an accountant and I'm not licensed with super. So that's, you have to go and get third-party advice on that. I'm here just to talk about the property side and basically how everyone looks at it, whether it's the loan or whether it's the ATO. It's just general information, just to open your mindset, just to show you what you can do. So the first thing I like to explain is, everyone normally starts work 18 years old. You might start work earlier, but 18 years old, your employer sets up a super fund. It could be with Rest, it could be with Australian Super, it could be with whoever. It could be in the coal mines with Mine Wealth, whatever it might be. And a lot of people will either A, hold that same super fund right through to retirement, or B, have 10 different super funds, which is worse. Like every employer opens you a new super fund. We get that a lot. You got like 3 or 4 different supers, all getting fees, all different, all just spread everywhere, which is a bit of a nightmare to fix, but it's definitely fixable. So the first style of super fund is what we call the normal style. You know, you could call it a retail fund or whatever you want to call it, but it's just a traditional super fund where your employer puts your money in. You really don't have much control apart from maybe picking growth, balanced, whatever. You've really got no control over it. So that's the traditional way. Most Australians have that. But a lot of people are leaning now, they're leaning towards what they call a self-managed super fund. So once your balance gets to a certain level, now depending on your scenario, that would be totally different, but you need to really see a 6-figure plus level in your super fund. What they do is they can actually set up a self-managed super fund and do their own investing with it. Now, you can do property, you can do shares. There's a number of different things. I actually think you can do classic cars. There's different things you can do with your superannuation within a superannuation fund when it's you're self-managed. So you're basically investing yourself. A lot of people steer away from that because they don't know what shares to buy or what properties to buy or whatever it might be. But a lot of people are like, listen, I've got 250 grand in my super. I'm not happy with my super fund. I'm not happy with super as a whole. How can I get more control over it? So that's when a client comes to me, normally from an accountant or normally from a financial planner potentially, and says, Wayne, this guy wants to set up a self-managed super fund and buy a property. Can you help them? And I'm like, no worries. You guys go and set up the fund and I'll find the property. But what we're going to do today is going to break down a few different parts of it for you so you can see whether it's something you might want to do. But it's okay if it's not for you. It might not suit your investment decision. So best thing is to get your own research on this. But I just want to break it down. It's a fantastic thing. You can really compound your superannuation fund, especially if you're a bit younger, you've got more time to make that happen for yourself. Alrighty, guys. So first thing is, normal super fund, we've all got that. Self-managed super fund is a bit different. So the best way of me explaining it to you, now there's 2 ways. There's the bank's way, which is so complicated, you won't even understand it, which honestly, it's a bit of a head knock. But I'm going to break it down with my little whiteboard here to explain to you how I sort of see it and how I see it come together. So guys, bear with me. I'm just going to share my screen now. I've got my little pencil here I'm going to draw with. Bear with me if I haven't used this before. So bear with me if I make a mistake. So I'm just going to share my screen here, guys. Where are we? That one. Okay, I'm hoping everyone can see that now. So I've started a little bit of drawing here. So this is how I'm going to explain. So this is how I would explain if someone sat in my office and said, I want to buy with a super fund. I say, listen, this is how it roughly works, but you've got to go get independent advice. So in this scenario, there's two parties. You've got person A here and person B here. So it's either husband, wife, wife and wife, husband, husband. What you've got to do here is each person has their own amount of super. Now, you don't have to do it independently. So I don't have to do one by myself. I can actually do it with my wife. I can do it with my kids. You can actually have several members of a super fund. I'm not sure how many exactly you can have, but to make up the amount of money you need, you can have more than one member. So you can have 2 members, 3 members, whatever you may need to make it all come together. But with this scenario here, what we've got is person A has, say, $100,000 in super here, and person B has $150,000. Now that would be normally, when I meet with these guys, this would be in their normal super fund, your traditional style super fund. But what they've got to do is they've got to go out there. Now bear with me as I draw this out, guys, is they've got to put together a self-managed super fund. The best way I can explain, like with my self-managed super fund, the best way I can explain is it's a company with super fund rules. So there's a lot of rules in relation to super fund, because the way you've got to see your self-managed super fund, or realistically any superannuation, like I'm 44, I can't touch mine till 60, whatever. But what you've got to see is you've got to see the self-managed super or your super as a third person or a second person in your relationship. It'll have its own tax file number. It'll have its own rules and regulations. It's got to get audited. You've got to do everything correct. Otherwise, the ATO can actually make you shut it down. So you've got to follow the rules, but your accountant can help you there to put all that together. And your accountant will normally organize all that for you as well. So the first thing you've got to do is set up the self-managed super fund. It'll have an ABN number, tax file number, full company name. It'll also have this other thing. There's other things called a trustee or members. Sorry, I'll say again. It'll have members. So normally the members are the two people, like A and B, right? So the members will be Mr. A and Mr. B. That's who your members are going to be of this super fund. But like I said, you can have member C as well if you wanted to. Like sometimes I see that where I have brothers and sisters, they join their super to buy property because they might not have enough, but one's got 50, one's got 100, one's got 180, whatever it might be. So they pull it together to buy property, right? Now, then what you do is, before you do that as well, the other thing I always say to people is, what you've got to be careful of is, and this is where you need independent advice, is you've got insurances. Most super funds, like say, for example, you're with Australian Super or Rest or whatever it might be, most of them will have some sort of life insurance, income protection insurance, etc. So you don't want to necessarily close down your traditional funds. You don't have to close them down. We're just going to roll over the money into a different fund. So you've got to be careful of, if you do have life insurances, you need to get advice on whether or not you need to keep your fund open, your traditional fund open, and whether or not you need to get insurance advice and set up a whole new insurance policy coming out of your self-managed super fund. I just would not want to see someone shut their super fund, open up the self-managed super fund, then realize they may not be able to get the insurance policy because they may have had a health event, which eliminates that. So very, very compliant. You've got to make sure you do the right thing there. So the first thing we've done here is we've set up the super fund. We've checked to see if there's insurances or not. We're just going to leave the traditional funds open. Then out of person A has 100,000, person B has $150,000. But we don't have to use all that money. But in this scenario, I'm going to, but you don't have to use all that money because you can just leave a chunk of it left in your traditional fund, which for most traditional funds, they're invested in some sort of managed funds, which is spread across shares and property trusts, etc. So you're still diversifying your money. But let's get off that subject. So you got your super fund, right? Let's just say person A and person B said, I want to roll over a total of $200,000. So person A might roll over, say, $80,000. Person B might roll over $120,000. So they've still got some left in their fund. So this super fund will have $200,000. Now, for most people, in most areas, $200,000 isn't going to buy you jack squat. So what you need to do is, okay, we need to borrow some money to help us fund a property purchase. So there's some rules and regulations around that as well. Because down here, we want to buy this property. This property is going to cost, let's just say $500,000, right? Look, we want to buy this property over here, but we need to basically borrow. If we had $200,000, the bank will normally give us a 30% deposit. Sorry, the bank will normally lend us 70%. So we need a 30% deposit minimum in most cases. You can do a 20% deposit, but seriously, I think your preference would be a 30% deposit here. But the problem is a super fund, amongst the rules of a super funds are not allowed to borrow money. So what they do is, between the ATO and the banks, everyone involved, they set up a system back in 2000 and something. What they did was they said, okay, what you can do is you can set up what they call a bear trust. Now, there's a few different names for this. It's called bear trust, custodial trust. It's basically a holding company at the end of the day. It's going to hold the property. So the bear trust buys the property on behalf of the super fund and borrows the money as well. So at the end of the day, what you're looking at there is person A. So I'm going to get rid of person C there. Let me get rid of that. It's going to complicate it. Yep. So person A and person B, they've got 250 grand combined. They've basically put in 200 grand into their self-managed super fund account, and they want to use that to buy this $500,000 property. They're going to use 150 grand. So over here, they basically transfer 30%, which is 150 grand. Because keep in mind too, guys, you've got stamp duty, you've got fees to set the fund up, all that sort of stuff. So it's 150 grand. And over here, they're going to borrow $350,000 from the bank. That's the loan. And then you're going to have rent coming in off the tenant to cover that loan for you. All right. So you've got to make sure all the numbers work, right? You have to make sure all these numbers work. Otherwise, it's just not going to work, and the ATA might not like it. Because when you're buying property in a super fund, so when we're out there sourcing property, we always get direction from the mortgage broker or bank or whoever they get the funding from in relation to whether they have postcode restrictions, whether they have property restrictions. So say, for example, I don't do this, but you may not be able to buy like a studio apartment in the middle of Sydney simply because the apartment's too small, or the postcode could be wrong. You might not be able to buy properties too remote because the postcodes are wrong. So depending on the bank, like we always get advice off their broker or bank. They tell us where we can and can't buy, and we work within the realms of that. But there's still, like, honestly, there's 90% of Australia you can probably buy, but there are some postcode restrictions and property restrictions. Like you can't buy farms, I don't think. You can buy commercial and residential. So commercial has a lot more restrictions though than residential. Normally residential is easier. All right, and there are rules too. Like you can't live in it, your kids can't rent it, stuff like that. So you will have to get advice on that, so you know what rules you have to play by. So that's how I talk about how it's structured and how it's put together. Now, the best thing with this is called limited recourse borrowing. So what that means is, if you've got $1 million super fund, if you're lucky enough to have $1 million in cash in your super fund, and you use 200 of that to buy property and borrow, say, 350 or whatever it might be, if something goes wrong and you lose that property, under limited recourse borrowing, the bank cannot go back to the rest of your super and obtain any money back from you. It's limited to just this one property purchase. That's what I like about super fund. It can't affect your whole super balance, but that's why you've got to put in a 30% deposit, right? That's why there's all these rules involved with the super fund. So you've got to be careful. It's actually, once it's set up and running, it's quite systemized and it's quite easy, but it's just a little bit of paperwork in the beginning, and then you can own a property in your super fund. You can drive past your super fund. You can, you can potentially, I think there is limits, but you can renovate your super fund property as well. All right. So I'm just going to, I'm going to show you how the bank's going to show it to you. That's right, wasn't I? So let me pull up this other one. So this is how a bank explains it to you in most cases. All right. Now, this is how the bank would sort of explain it. Now, when you look at this, right, this whole structure here, it looks complicated, right? But once it's set up, it just runs. It's just like a company on your internet banking. You got to make sure all the rent goes in there, all the bills are paid out of that one account. So for those of you who are self-employed and already have companies, you'd understand it a little bit more. But if for those of you guys who are PAYG, employed, you get your tax taken out, blah, blah, blah. You may need a little bit of education before you enter into this, but not much. It's just a little bit of understanding of what you're getting yourself into. And you have to make sure a property is the right thing for your super fund as well. But that's how a bank will explain it, right? So that's why I didn't explain it that way, because honestly, sometimes I get a headache looking at that as well. So the best thing, super fund. So you can do it. That's how you put it together. Now, a couple of things I know, you can't build with a super fund. So you can't have a construction loan. The property has to be established. It doesn't have to be brand new. It doesn't have to be 100 years old. It's just got to be a solid property, solid postcode, solid area with a good quality with tenancy. And say, for example, you find a property and the bank doesn't like it, they'll let you know before you go unconditional on the contract anyway. Okay, so we don't normally have any problems, but that would definitely be there. But yeah, that's how you structure to buy a property with your super. So from my perspective, it's a good way of controlling your money. Like for those of you who know me, I'm a huge control freak with finances because I believe I can do better than what banks and everything can do using property because of my experience. So with you guys, you've got to make sure that it's what you want for your investments. It's what you want for your super fund. But some people I see have 300 or 400 grand in super combined between mum and dad, say, and they just want to use some of that to buy a property. They don't want to use the whole lot. And then I've got other clients who have, you know, $500,000 in super. They just hate their super. They just go buy the property outright. And when you do that, you don't need to borrow any money. So you don't need that extra bear trust. You just buy it with your super fund. So guys, all I wanted to explain to you tonight was a little bit like that, because that post did get a bit more reaction than what I thought. I didn't realize people weren't aware of what you can do with your super as much as what I found out, to be honest. So that's how you do it. So the main thing is a self-managed super fund is a little bit more work for you, not a ton. Your accountant will do most of it. The structure of it all, I just went through that with you there. Limited recourse borrowing, which is normally when an accountant or a banker will talk to you about limited recourse borrowing, your eyes potentially could glaze over, but that's okay. Everyone does that. Now, as far as qualifying for, say, a loan for a super fund, like I mentioned before, if you want to go buy a $500,000 property, you're going to have stamp duty and different things on top. So most banks, to my knowledge, will lend you, no, sorry, not most banks. Some banks will lend you 20%, sorry, 80% with a 20% deposit. Other banks will lend you 70% with a 30% deposit. And of course, less. You don't have to borrow up to 70% either. But what you're going to be aware of is I always recommend, especially with a super fund, loan, is to speak to your broker. A lot of banks don't do them, if that makes sense. So out of, whatever we've got, 50, 100 banks, whatever we've got in Australia, you might only find 10 do super fund loans. There were more, but at the moment, there's only about 10. You'll find interest rates are a little bit higher than what you're paying now as a home loan rate or an investment loan rate. Some banks make you pay principal and interest repayments from the first day. They won't let you have interest only. So when you're chatting to your broker, what you've got to find out is what will you qualify for and what lenders they're going to use, what interest rates they're going to use. So then you can work out the numbers to see if it's worthwhile for you or not. Obviously, the bigger deposit you've got, the better. And some banks even offer you the old offset account as well, which is awesome if you've got a bit of surplus funds too. So, but as I said, if you've got most of the purchases we do for super fund properties are under the $600,000 bracket. So most of those clients have to have around about 200 grand in the bank to do 150, 180 grand deposit plus costs. Some banks prefer you also, I forgot to mention, they prefer you to have 10% of what we call liquidity. Now, liquidity is basically cash in the bank left over. They prefer you to have another 10% of cash left over too. So as I said, you've got to speak to a broker first there too. But if you've got a couple of 100 grand, between mum and dad or brother, sister, whatever your scenario is. They could have 3 people involved, 4 people involved to do it. You should be able to have a chat with someone about buying a property with your super fund. Setting up a self-managed super fund and buying an investment property there too. It's quite easy to work out once you have all the basics down. Yeah, but that's about it, guys. Now, guys, I can't see my comments on here, so bear with me. I'm just going to see if anyone's got any questions. I've just got to have a quick look to figure out. I can't quite see that. Give me 2 seconds. All right, so if you've got any questions, please whack them in the comments in there now. Okay, it's not quite working, sorry guys. That's okay. I can't quite see your comments, sorry guys. But if you have any comments, whack them in there. What I'll do is, if there's some comments there, I can reach out to you direct, worst case, and also answer your questions that way, or I can do another live just answering your questions. I don't care. That doesn't bother me whatsoever, guys. But guys, thanks again for watching tonight, whether you're watching it today or whether you're watching it on replay down the track. But that's how we do the self-managed super fund structures. And that's how our clients are buying property with their super fund. Alrighty, guys, thanks again and have a great night, and I'll chat to you again soon.